All right, when you're ready, let's
Leave all
go.
this stuff in.
Yeah, this is the stuff that people tune in
It's
for.
good stuff. It's good stuff.
All right, when you're ready, let's do it.
All right, man. Let's do it.
I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Stephen Kiel. He runs Arquitos, and he's got a lot of other interesting investments. He's a special situations investor. We're going to talk to him right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
Hey, Steve, how are you?
Hey, man. Doing great. Thanks, Toby.
So, Arquitos, that's your fund you've been running since 2012. It's returned 16.9% after fees, and it says in the document that you sent through that you're a special situations. So, do you want to just talk a little bit about what you do at Arquitos?
Yeah. So, I mean, special situations can mean a lot of different things. To me, I'm looking for companies in transition. I'm looking to maximize company-specific situations and kind of minimize external things. So it's a variation of value investing in the way that I apply it, kind of based on my personality, but requires concentrated approach, a lot of kind of aligned interests with the companies themselves. But ultimately, I'm looking for companies that are in transition and that I can acquire at a reasonable price.
So I saw you described it as having a strong balance sheet and then some pathway to free cash flow. So is that you're looking for something that the business isn't sort of the business's strength isn't reflected yet in the financial statements? Is that right?
Yeah. So I do something called balance sheet to income statement investing, and it's based on kind of a quote by Peter Cundall back in the day. He said he buys on the balance sheet, sells on the income statement. Now I don't want to sell, but how do you acquire things at reasonable prices in this environment, applying a Graham style approach. And to do that, you have to find things a little bit earlier, I think, than in the past, or you have to find things that there's a little bit more uncertainty in the public reports, but you can follow some of the incentives in the company themselves, whether it's because of incentives to attract a strong capital allocator, there's insider ownership, alignment of interest, and that type of thing. There might have been back in the day, 5 years ago, there were things like tax loss carryforwards were more important as well, and other type of off-balance sheet items or incentives based on that. So I want to buy when the balance sheet is strong, when it's reasonably priced, when there's something specific going on at the company that might unlock that value over time. And then there's a transition that would be made to reinvestment opportunities, predictable free cash flow generation over time. That's where I want to continue to own and hold on to a company over time, hopefully for many, many years or decades.
So that's a pretty good statement of the theory. Can you give some examples of how you have applied that in the past?
Yeah. Well, with a larger company, even a Bank of America or some of the banks coming out of the crisis, where there was several years where they were trying to strengthen their balance sheets, and they had, their kind of repurchase and capital allocation decisions were controlled either by the government or different regulations. And you look at from 2009, 10, 11, 12, especially with the TARP warrants, with all the major banks. There was a great opportunity there to really get quite a bit of value by buying on the balance sheet, buying for balance sheet purposes. And then most of those banks over the last few years have now made the transition of having predictable cash flow generation, predictable return of capital. And even today, you can get really reasonable and attractive returns simply based on return of capital alone. Now, that's an example for a larger company. I owned Bank of America TARP warrants for many, many years. And actually owned it for about a 5-year period. The price didn't move at all. And then after the election, when Trump was elected, I think the next month it doubled. And then a few months later, it doubled again. So over 5.5 years, it looked like a tremendous investment. But for 5 years, it could have been accused to be kind of a value trap there. But then all the way on the other side, there's great examples for smaller companies that we've owned as well that are a little bit more unique, I think.
Well, let's talk about those smaller companies. I participated in that the TARP warrant. I found that later, so I got very lucky with that. But let's talk about the smaller companies.
Yeah, there's a company today that's my largest position. It's called MMA Capital, and it's made the transition over the last 6 or 7 years from this balance sheet type of approach, reasonable valuations, to now it's transitioned into the income statement predictability. Other investors haven't really realized it yet, and it's also a very small company. It's a $200 million company, and it does have tax loss carry forward, so you're not able to own more than 5% of the company. So this is good for small funds. It's good for personal accounts for larger investors, but it's a little bit of a complicated story, and so it's not attracting. It's too small for very large investors, but it's a little too complicated for general retail investors. So it's good for our sweet spot with a smaller fund. And the background there were a number of off-balance sheet items, off-balance sheet assets through the years. They were buying back about 10% of the company per year for 4, 5, 6 years in a row. A lot of insider ownership, alignment of interests, and again, we're not paying any taxes on the assets that they were selling. So the balance sheet, the book value was growing every year, and they were transitioning into a different type of business. And their specialty asset manager, and now their primary business is much different than it was 5 years ago.
What's the transition been?
Yeah, so their primary business now is a solar lending fund, and they partnered up with, ironically, Bank of America several years ago. They'll likely throw off $6 a share next year, and just from the returns from the solar lending fund, trades at $32, book value is 37 and change, and so it's it took several years to create that predictability, but now you're there, and we're just waiting for kind of last 12-month comparisons, and then it'll start showing up on screens, and then because it trades below book value, it also throws off so much of this return over the next year. We're going to have income statement style investors start buying into the company that were not interested in the company for all those years where it traded at 80% of book, but did not create predictable cash generation.
So in your last investor presentation, I think, or letter, you had that as a 39% position in the portfolio,
yeah.
But I got the impression from the note that had grown to that level. It's nowhere near initiation at that level. So how do you size something like that in the portfolio?
Yeah, so I generally when I buy into something, I want to make it at 8 to 10% at cost, and it's just grown over time. You don't want to pull the flowers. So if something grows, if it becomes an outside piece of the portfolio, if it trades at a reasonable valuation, and MMA today might even be cheaper today than it was when I first bought into it 5 or 6 years ago, because the operations have improved so greatly, and it still trades at a discount. I mean, again, book value is 37 and change, and we're at a little bit below 32 today. And they continue to buy back shares below book, which is accretive, obviously there, but. So it might be cheaper today than it ever has been, but it grew from 10% of the portfolio at cost up to anywhere between 35 and 40% today. And I'm happy to own it at that price because there's still a pathway over the next 5 years for it to grow 30% a year from here. And we'd love to own it from there. Wouldn't it be great to have a 40% position in the portfolio that grows 30% a year for 5 years? I mean, we can sit back and relax for a bit. Huh?
So I have followed another position in your fund pretty closely. I think anybody who's been a deep value net guy knows Sitestar, which was they have the machines that convert coins into cash, I think, right?
Oh, Coinstar, yeah.
Coinstar. Did I say Sitestar? I'm sorry.
Yeah.
So am I confused? What is Sitestar?
Yeah, well, Sitestar is a small public company. It took over in 2015, and background was it was an internet service provider, actually. So when you think about what's more simple than maybe a coin-operated machine or something like that, well, it's dial-up internet. And so we had that. It had some real estate as well. Jeff Moore and myself and Jeremy Gold helped to kind of take it over in 2014, 15. And a small public company. It was an SEC filing company. And when we took control in December 2015, we had some ideas, primarily in the asset management area, which we've executed through the years. We have a couple other businesses associated with it as well that are kind of non-core at this point. We learned a good lesson not to be diversified, quite frankly. We did change the name to Enterprise Diversified, which I think was a mistake, because we're really trying to focus on the asset management area, where we found a lot of success and teamed up with a lot of great people, including Dave Waters and Jeff Gannon, Andrew Kuhn, and Keith Smith, and others like that. And so that's the part of the business we're really trying to grow. We think there's a ton of potential there.
So you guys got control of that business. Can you talk us through that process and how you found it, what the process of getting control was like, and what it's been like running it?
Yeah, when I first found the company, my fund was fairly small, and so you could have a position in a sub $10 million company, for example, especially when it traded at about a quarter of book value. And I thought there was some additional value off balance sheet. I mean, there's historical prices on some real estate and things like that. So Jeff Moore actually was the person who originally found it. And I was going to own it just as a passive investment, and owned it for a few years. And then Jeff and we would regularly meet with the CEO, chairman at the time, and we're obviously unimpressed with kind of some of the decisions he was making. And then it turned out there were some self-dealing and things of that nature. So we ended up getting on the board, and we ran a proxy contest, and eventually, I guess, instigated him to step down as the CEO, and we took over. Ironically, now we're about 4 years in, and the stock price is about the same. So I can't say it's been it went up and then it's gone back down again here. So it's been a bit of a challenge, but the things we've done, especially again in the asset management area behind the scenes, there's tremendously more value than what's reflected so far, and it's really would be very, very difficult to replicate the formal relationships that we've built with some of the really talented portfolio managers.
We'll come to Willow Oak in a moment, but just how much cost and how time consuming is it to get control of that board, and what was that like?
Yeah, I think I don't remember who said this, but I think it was Blackstone or something like that, where basically he said if you're going to put in the work, you might as well do it for a larger company as opposed to a smaller company, because the same amount of work, the payoff can be much greater. And so I obviously didn't know that at the time, or maybe didn't take that to heart. So there was a tremendous amount of work in 2014, 15 time period, and in early 2016, not only to take control of the business, a lot of legal wranglings and things like that, but then also once we did take control, we right-sized the internet operations, turned it into a really regular, predictable, free cash flow generating entity, and sold off some of that real estate, and then entered a few other business lines as well. So it was a lot of work at that point. I now am chairman. I was CEO at the time. I'm now chairman of the company. We've got a great team. It takes time to build that team out too. It probably took us 2 years to really get the people in place at the senior level that we needed to do. And if we would have had more resources, if it would have been a larger company, I think that would have been easier. So my advice, if anybody wants to go activist, is first of all, don't. It's probably not worth it in the short term, though it will be worth it in the long term. And second, if you're going to do it with a larger company. If you're a small fund, it's difficult to do with a small company because the expenses are still going to be substantial, and you have to make that transition yourself, and it's difficult to build out a really talented team. It takes time to do that if you don't have the resources, especially. So it's better to have kind of more infrastructure in place, I think.
So the asset management business, Willow Oak, that's wholly created by you?
So we started Yeah, we started that in 2016, and the initial purpose was to seed Alluvial Fund, which is a fund we started with Dave Waters. And Dave had run some managed accounts for several years. He ran the blog, continues to run the blog, OTCadventures.com. And Dave and I go back many years. We shared stock ideas. He's probably fairly well known in the value investing and especially small and micro cap communities. And so, he had been successful with the managed accounts. He had wanted to start a fund, and we approached him and thought it might be worthwhile to really be strong strategic partners to do that. So we launched the fund, we seeded it, we raised money at the public company. We created the asset management subsidiary, Willow Oak Asset Management, and that was the genesis of it. From there, we ended up launching a fund with Keith Smith called Bonhoeffer Fund, and Keith is on our board. He's fairly well known in the corner of Berkshire and Fairfax, and many of these events, Fairfax event and things like that. He's a great guy, and we were excited to launch it with him. And then most recently, we're launching a fund actually on January 1st with Jeff Gannon and Andrew Kuhn at Focus Compounding. And
so the focus of all of those, the connection between all of them, they're all value guys. But beyond that, is are you looking for any particular style, or you're just looking for folks who are value investors generally?
Yeah, at this point, because Willow Oak is still small and growing, and it is kind of all part of our network and my network, and so I didn't just meet these guys one day. We've had relationships for many years, and I always was impressed with them, impressed with what they're doing. Each one of them had a very great long-term personal track record that we thought could translate into a fund. So that's where that came from. Each of them wanted to start a fund, and we were there. Willow Oak was there to assist with that and to provide some best practices and operational support and things like that. So in the future, I don't know. I mean, we're niche value. We've got each of the funds has a slightly different approach, but all with the same foundation. And I think it might even be a little charitable to call them emerging funds at this point. So it might be frontier funds, but the runway is long. And if any of you follow kind of the Peter Kaufman 5 Aces thing, there are a number of things there that, having integrity, having a niche approach and things like that. But the fifth one is having a long runway. And I think each of those funds has a long runway. And when you think of the fees that they could earn, the fee shares that Willow Oak can earn, the return that we can give to the investors in the funds themselves, 5 or 10 years from now, just from the performance and compounding and things like that alone, we'll all be very happy.
And so Willow Oak provides back office function and some assistance with raising capital.
Yeah, so the back office is the biggest thing, especially for just kind of the operational infrastructure. That if you're starting a one-man fund, which I did in 2012 when I started Arquitos, there are a bunch of best practices that you just have to learn along the way, and there are expenses associated with that. There's kind of showing that you're not just a one-man band. And there are, a number, especially as the investor base grows, there are just a number of distractions potentially that need to be done. Interacting with the auditors and the administrators and legal and just keeping all the track of everything and compliance. And so Willow Oak was designed to kind of provide some of that to reduce the risk, monetary risk for the startup. We have paid for the launch of the funds themselves, and the idea is to kind of solve a problem. And then certainly there are people investors who discover one or more of the funds, and some allocators, they want to spread money around amongst several different funds. They like the philosophy of each one, and so we definitely have overlap with investors as well. And we have an opportunity to have some joint marketing. We do a thing at the Berkshire Hathaway meeting every year. That you can see on our YouTube page, panel discussion and others like that. So, and it's been great to kind of learn from each other and to be able to have formal resources there.
And how do you divide your time now between Enterprise Diversified and Arquitos?
Yeah, most of my time is with Arquitos. Now that we've been able to build out the team at Enterprise Diversified, so my job is really more as a strategic, person, a cheerleader, and the network that I've kind of built with the investors themselves and with the different portfolio managers and other that's been valuable. And then our operations staff kind of handles all the day-to-day. So I'm not as involved in the day-to-day very much anymore. We've got a great team at Enterprise Diversified and Willow Oak to do that. But I'm kind of here to talk to you and do these events and help to promote the business and help to explain the business too and show how excited we are about it.
So what's the plan with Enterprise Diversified? Is it to turn it into an asset management company, or will it be a more diversified, as the name suggests?
Yeah, we're going to have to drop the diversified portion there. Originally, the idea back in 2015 and 16 was to invest in a few different types of businesses, different types of industries. But the idea was for us to be funding partners and to invest in the operators themselves. But unfortunately, at that size, the operators that we invested in, it just wasn't going to, in hindsight, it hasn't worked. And it's unlikely to work at this size as part of a public company. There's a reason why most of those companies are and should be private. But where we're most excited about and found the most potential in was in the asset management area here. And so that's where the focus is at this point. We have several other lines of business. We have the old dial-up internet business. We have some real estate. We have things like that, which are really non-core parts of the business at this point. What we're trying to do is continue to grow our investor base in the funds that we're associated with and to continue to kind of create formal relationships with new portfolio managers.
You've had some criticism on Twitter from the Woodmont folks, Tice Brown. Do you want to address that?
Yeah, so this is one of the issues with the real estate. This was a part of the non-core business there. We had sold off a portion of the real estate to Woodmont. And as part of that sale, there is a confidentiality clause in the agreement, which unfortunately Woodmont has violated, but we will not be violating that. So we filed a lawsuit listing several items associated with it. It's an unfortunate situation there, but the only things we will be able to mention is through 8K filings and things of that. But I think the important thing there is, again, our focus is on the asset management business, and some of the other lines of business are such a minor part at this point. When we first took over the business, the book value, for example, of Enterprise Diversified was kind of the way to value the company. And it's really not the case anymore. I mean, the same way I've approached through Arquitos, finding companies that are in transition, that transition from book value kind of analysis to income statement kind of predictability. That's kind of where we're at with Enterprise Diversified as well, where we are in the midst of that transition, and the asset management area is really where most of that is, the fee share and different relationships with those managers, and so our book value for the non-core businesses used to be such a big part of the business, and they're really not anymore.
Well, let's go back to Arquitos. How are you finding your ideas there? You say you don't screen, so what's the process for generating ideas?
So I always believed in primary sources. So my background is as a recovering lawyer. I joined the club that you're a member as well.
Yep.
And we're not alone. And so we're not averse to glancing through. We might need to cut that.
Steve's logo just fell off the wall.
We'll go back to the question there. Hopefully, it's not
it's not portentous.
An omen. Yes. How the market's doing today, but No, so my background is as a recovering attorney, and so we're not averse to kind of reading through several hundred-page documents. It's not just the 10Ks, but it also might be an employment agreement and things like that that are essentially SEC filings. So that's where I go. I go to the primary sources. I have a number of SEC alerts set up. When you think about an S1 filing or an S3 filing, I love those. We get 5, 7, 10 of those a day. Obviously, I don't read through each one of them, but I at least glance through and set aside some of the more interesting ones. And so, that's a great place to look. I'm looking through employment agreements. I'm looking through different key terms, such as contingent value rights, rights offerings, tender offers. And occasionally you'll come across something interesting and you follow that lead.
What was your area of practice as a lawyer?
Yeah, so I did a lot of government investigations and some things like that, some M&A, more on the HSR side, second requests and things like that. And I actually am still a lawyer in the Army Reserves, about 20 years in, and am a defense attorney. It's a little bit different than the private practice. But when I was practicing, this is 2007, 8, 9 period. There were a number of companies where you really see behind the scenes. I mean, when you're doing some sort of a government investigation, you're reading emails and different kind of background information on the leadership of public companies, oftentimes. And it gave me an appreciation for how little the public actually knows about what goes on behind the scenes. And when you think about this idea of alignment of interest, I mean, we all want alignment of interest with the investments we're passive investors primarily. And so you'd have to be able to trust the decision making of the public company. But you're just not going to know nearly as much as you think you know. I mean, whatever you think you know is 10% of what is actually going on behind the scenes. And being a lawyer and kind of reading that type of stuff gave you even more of an appreciation to make sure that you truly have the alignment of interest. So, you do have insider ownership, you do have good capital allocation kind of decisions made, and there's not very many companies out there like that, which is why you have to concentrate.
So your primary area of search is the S1s, S3s, which are the security issuance, and you like contingent value rights and things like that. So you're looking for that transitional period.
Yeah. Yeah, and I found a number of different things through the years. I mean, an investment in 2012 with a bankrupt ice company. For example, there was some equity stub value coming out of that. I had a great investment in 2015, 16, 17, Intra-West Resorts, which was a company owned by a Fortress fund where they did a huge tender offer and then ended up getting sold. So that type of it depends on each situation, but you're really looking for something that's company specific. It has less risk and less variables outside of the company, and really something specific as to what's going on, where management has control over the situation. It can control the variables.
Right. So are there many S1S? Are there a great deal coming through?
Yeah, and I think there have been, but I think over time, especially as give it the next couple of years, I'm actually excited about more corporate restructuring, especially with larger companies. The first 4, 5, 6 years of the fund, I'd invest in some smaller companies. Obviously, we talked about Enterprise Diversified, very small company, but I also owned, obviously, the Bank of America TARP warrants. I owned Phillips 66 spinoff. I had some larger companies. Iron Mountain went through a conversion from a real estate investment or into a real estate investment trust, and that was an opportunity. I think it was 2014 time period. And so these are some larger companies. And then as the markets have reacted in the way that they have the last few years, those types of obvious opportunities start to go away, and there's not as many company-specific corporate restructurings. But as we get a correction, as we get more turbulence in the market, I think that'll provide more mid-cap and large-cap company kind of introspection, which would create some opportunities for me to look at.
So we've discussed already MMA Cap and Enterprise Diversified. That makes up a little bit over maybe almost 2/3 of the portfolio. So what else have you got in the portfolio?
Yeah, so probably a little bit below 60% there, but I've generally had top 5 positions make up 75% of the portfolio ever since the launch of the fund, and probably a little more concentrated than that prior to when I launched the fund. But we've got a company called Westaim that I really love. This has not been a great performer on the price side, but it's been strong operationally. And so over the last few years, they've strengthened 2 subsidiaries. One is an insurance company. They've strengthened that, and they're looking to sell it off or possibly IPO it this spring. And then they also teamed up with Dan Zwirn and Arena Investors with a credit fund. And I think they're up to 1.2 billion or so in assets, up from 700 or 800 million over the last year or so. So they're growing. They reached a tipping point. I think they became profitable at about $1 billion under assets. And so the business is doing great. It's really advanced. It's operationally been very strong. And the stock price, though, has been crushed. Book value is somewhere around 337 or so Canadian. The stock trades at 265, which is just it's ridiculous. But it's great for us if we're in the acquisition mode.
Why the big discrepancy?
Yeah, it's a Canadian company, and there were some Canadian small cap mutual funds that had closed down over the last year and a half or so. As you know, small cap value is not the best place to be in the last 2 years, and some mutual funds really struggled there, and especially in Canada. So I think there's some forced selling associated with that. I will say Parag Shah, who's a friend of mine, he's the head of marketing at Arena. He used to be the head of marketing at Bridgewater. He's an advisor to Willow Oak as well. And he just made an open market purchase of Westaim shares about a month and a half ago of $1 million. And so, clearly he's happy about what's going on there, not kind of talking privately or, any confidential information there. But when you see an insider purchase that large from a non kind of CEO, COO, CFO, and he is close to, the future of the credit fund and what their asset raising opportunities are over the next few years than anyone else. He made a very large personal investment there. So that's a great sign for the company. And next spring, too, we'll have a resolution on the insurance company. And there's a significant amount of additional book value there from the insurance company that will be, cause that difference between the current price and the book value to grow even further.
So these are all particularly interesting positions. How do you transition from being a lawyer to being an investor in things like this?
Yes, it's a good question, and I always was interested in things like this. Going back to even before I graduated from law school, as a personal investor, I was always interested in kind of niche things and idiosyncratic things, things that are maybe not well-known, companies that are not average, would not have been well-known from the retail investor. And that goes back to probably the late 90s, early 2000s. And I always appreciated the Buffett partnership letters more than the Berkshire Hathaway letters.
Right.
We all can kind of point to Buffett one way or another as some sort of inspiration. And I read the book back in, I think it was 1996, the Lowenstein book, Making of American Capitalist, and I remember reading that and, being more interested in the portfolios from the 50s and 60s than buying, say Coca-Cola in the 80s. So I always gravitated towards those unique situations.
That's funny because when I was reading through your letters, I had that, you discuss workouts and control situations, and I thought this language is very reminiscent of the Buffett partnership letters.
Yeah, I try to stay away from the word wonderful though, because somehow he transitioned from workouts and and everything like that to buying wonderful businesses at reasonable prices, which is whatever the value investors have turned into today. The word value means whatever people want to define it as. But try to stay away from some of the more colloquial words like that.
It's funny. It's not. It's a. I know it well, and I've talked about it a lot. But that Buffett partnership, Buffett is a much different investor from latter day Berkshire Buffett, where he was a corporate raider in essence, a corporate raider, a liquidator. He'd get control. He was pretty ruthless when he was in those early years, and he transitioned. But I think even in the later days now, where he's in that wonderful company at a fair price, the fair prices that he likes are still pretty cheap. I think for many of the positions, a lot cheaper than a lot of modern day value investors seem to be prepared to pay anyway.
Yeah, absolutely. And he talks about the transition kind of being made into a little bit more of a Phil Fisher style investor because of Munger. But if you look at Munger's partnership back in the late 50s the 60s and early 70s, I mean, Munger was not that type of investor either. Munger was primarily a special situation investor, and he had some fascinating investments with Rick Guerin and had some with Buffett as well. But Munger took over a closed-end fund. He did a number of obviously blue chip stamps at the time too, and he was concentrated. The rumor is that I don't know how true this actually is, though people reference it from the Munger book, that at one point he had more than 100% in one stock. So he was levered. He was obviously much more volatile than Buffett. But at one point, he apparently had more than 100% in one stock. So he's always been much more concentrated. But even Buffett himself was concentrated. I mean, the American Express position back in the salad oil scandal days, I think it was 50 or 60% of the portfolio. So somehow, hedge funds turned into an asset class over the last 50 years, and it turned into this portfolio that is kind of a glorified mutual fund. And that's not what I'm trying to do. I'm trying to do things that would have been done in the 50s or 60s in the era of the Buffett and Munger and Guerin and others like that.
One of the things that I noticed from your letters too is how small those partnerships were. I think you said Munger had 11 million, and Walter Schloss, how much did he have in his fund when he closed it down, or at sort of later on?
Yeah, something like, I forget what Schloss had specifically, but it was also not very large. And if you think about in today's dollars, I mean, Munger, I think, was 50, 60, 70 million in today's dollars. Schloss was somewhere around there as well. Schloss was much more diversified, of course. But even Buffett, it was 300-400 million or so at one point, and kind of in today's dollars, and maybe eventually made it up to about $1 billion, but that was through appreciation alone. And there's a lot of billion-dollar hedge funds today, and back then it would have been one of the largest, if not the largest, fund at the time, and certainly size limits what you can do. Absolutely.
And Buffett's investments were reflected. The size of his fund reflected those investments. So I've gone through, and it, particularly even when he was talking about the transitional type investments like American Express and the rest of the portfolio was sort of these tiny net liquidation positions.
Yeah, Dempster Mills and others like that. And these are companies that were obviously not, I mean, even the Berkshire Hathaway at the time and others like that. And you can certainly do more Graham-related things. And back then, valuations were much, much cheaper on the balance sheet side than they are today. But you could do those types of things at a small size. And I think you can still do them today. You just have to be concentrated. Westgame or an MMA Capital or an Enterprise Diversified, or, I own a company called Pendrell that went private about a year ago. And it's a cash box, and it trades at 75% of net cash, and it trades at $160,000 a share because they did a reverse split. But there's still things like that out there, but a lot of them turn into kind of what are called one-day stocks. They're at a particular price. Pendrell, for example, is just going to be where it is at. And then one day it'll do a transaction, it'll go public again. And, it could go up 3 or 4 times from where it trades at now or where it's valued at now. based on that transaction. And that's kind of interesting, but it also requires discipline on your part as a portfolio manager. It requires alignment from your investors as well, to make sure they have an appreciation for what you're trying to do, knowing that there could be volatility on the results. That doesn't mean there's volatility on the operations, though.
Given that it does require this sort of level of discipline and the opportunities are infrequent or rare, do you tend to carry cash?
Well, I think if I was larger, if the fund was larger, when it becomes larger, there'll be more cash kind of set aside as an option. There's the idea that you do want something there to take advantage of sharp drops or to take advantage of unique opportunities that come up very quickly. Historically, I haven't had cash on the side. I've been fully invested. I do keep kind of a black swan style hedge on, with the idea of being able to sell it in order to generate cash to put into a watch list item if there's a sharp drop. There's the old saying that the markets kind of take the stairs up and the elevator down, and probably more so than ever today because of, we've got electronic trading, we've got all of the issues with index funds and other pressures. The black swan style kind of protection there is probably not a bad idea. So I've done that, and it's been helpful.
What have you done? How have you structured that?
Yeah, so I haven't gone into a whole lot of detail because some of the instruments we do this with are not the most liquid things, so I don't want to give it away too much. But it does involve, some sort of volatility or an option or something like that that moves very sharply when the markets drop quickly. And I don't want to continue to own it. It's not a market hedge. It's not a portfolio hedge. It's something that when the market gets a sharp correction, I want to sell it within a short amount of time. And, there was no better example of this than, again, going back to the election when Trump was elected. If you remember, the markets were down very, very significantly that evening. And that hedge, I think at the time my fund was worth $7 million in assets or something like that, and the hedge itself was $1 million. Was worth $1 million. However, the market opened up the next day because, if you recall, at about 5 a.m. Eastern time, Carlisle woke up and said, "I'm going to put $1 billion to work the next day," and the Dow recovered, the pre-market recovered, and I think the market actually opened up. And I never had the opportunity to sell the hedge since it did not allow for the instrument did not allow for non-market hour trading. And but it was fine because the rest of the portfolio benefited obviously from the markets going up and some of the specific holdings we had. But that would have been a tremendous amount of protection and cash that would have been generated that I could have put to work in that turbulent time period.
It's funny. I've had variations of those hedges on. I've had front month VIX calls. I've had out of the money.
Don't give it away.
Well,
don't give away the secrets.
like you, I've never cashed one in, and I've had some pretty monster winners. I had some HYG puts. And I've had I used the Spitznagel just buying out of the money puts on the market. So the HYG is the high yield index, but I had the VIX calls at that same time, and I woke up or late at night. It might have been 22% of my PA, and again expired worthless. I've never cashed one in, but they've all been at various stages, very significant portions of the portfolio.
That was a wild night, and I remember I was actually in California. I was in San Diego at the time, and it was such a wild night for the markets. I stayed up all night, and to be able to be 3 hours behind as well, 3 hours behind New York, and to see, hey, Carlisle at 2:30 in the morning is making these announcements on CNBC.
Do you think he bought?
I don't know. How
did he transact?
Go back and check the 13Fs or something like that to see what he did. But his statement alone seemed to be enough. And, it worked out. I mean, when you think about the reduced regulatory and regulatory environment approved, especially with the banks and lending and kind of business optimism, it certainly was beneficial to the market and has been the last few years. Nobody else could have got through a corporate tax cut. Nobody was talking about corporate tax cuts at the time. It was probably a negative for Arquitos though, because at the time I was benefiting from these net operating loss carry forward companies. But I had the Bank of America warrants. Other people owned the financials, and there was a sharp move over the next month or two after the election that otherwise would not have occurred.
Do you know that one of the things I think that gets lost in the shuffle a little bit, that move actually started on the Thursday before the election. And I sometimes wonder about that. I don't know what that means.
Yeah, I don't know either. Maybe there's a predict it style element to it that
right.
you know, some people with larger allocations than us might have known something, but it certainly benefited the banks though, and the warrants themselves were, you know, I started my fund on April 10th, 2012, and I had been running managed accounts for 3 years before that. I owned the TARP warrants there. I owned them in my personal account. And so that was the first thing I had bought, the Bank of America TARP warrants. And, you know, we look back at Brian Moynihan as being kind of a leader right now. You know, with him and Jamie Dimon are really the most stable, sober leaders in these large banks. And that wasn't the case back in 2011, 12. And Moynihan did not have the reputation he does now, really until Buffett ended up buying into Bank of America. In some ways, he diluted shareholders in order to increase his credibility, and Buffett got a great deal there. But
it seems to have worked for shareholders.
It works for shareholders over the long run as well. But those were the warrants I bought. I liked what Moynihan was doing in that time period. I was most comfortable. I thought that was the lowest risk. And, you know, also I thought there would be some interest rate increases. And when you think about the deposit base of Bank of America, they had the lowest cost deposits because of kind of the retail network and things like that. And they obviously would benefit the most then if there were interest rate increases, and that hasn't happened. But the banks have still benefited, and Bank of America has still benefited because the return of capital is so high relative to what it was before. I mean, they're all overcapitalized still.
Those Bank of America TARP warrants were very interesting. I didn't get to them until much, much later, but I remember the stock hadn't done anything for a long period of time, and I think I bought them I don't think there was much premium in them at all at the time that we bought them, and they were trading they didn't have to go up very much at all to be materially in the money, and I think they were 2021 or 2023. They had a long time to run, and you were getting a free hit if it went up. That was about the full extent of my analysis. Yeah,
and well, plus they weren't priced appropriately for a number of reasons. You know, the Black-Scholes doesn't really work on these long-dated things. The strike price themselves dropped, you know, as dividends started. And now ultimately the B warrants, you know, they expired worthless. Those are the old Merrill Lynch ones, I believe. The strike price was $30.79, and they expired worthless. But you know, it was an interesting thing to look at. And if you're interested in Bank of America, why not own a little bit of a different instrument? You know, and that's kind of been the way that I've approached it since the launch as well. Is when you find a large company, if you have a different way to play it, where you might have an additional opportunity. Joel Greenblatt talks about this, and You Can Be a Stock Market Genius, that when you have an asymmetric situation, you can really juice those returns without taking on really too much additional risk. And that was exactly the opportunity there with the TARP warrants. And even Berkshire Hathaway, for example, through the years, I've done long dated options on them when it's gone to a price below what Buffett has bought at. There were times when it was 1.2 times book, 1.3 times book 5 years ago, that you could buy these options 2 years out with a strike price at 1.2 times book at the money. And, I made 100, 200, 300% returns on some of those positions. They were 1 or 2 or 3% positions. But, certainly at some point over the next 2 years, if it trades at 1.2 times book, it'll increase a little bit. And your downside risk is minimal. And your upside risk is with the options are several times more than it would be with the stock itself.
Yeah, I agree. I'm a big fan of those elite warrants, and I freely admit that I got the idea from Joel Greenblatt. It's a great idea.
Yeah. Well, read that. I mean, yeah, that's You Can Be a Stock Market Genius book has so many great tools.
Yeah.
Goofy title, but really in-depth strategies that you can apply today. And the leaps are a big thing because the options. I really do believe the options market kind of did not exist back in the day in the same way that it does today. You'd have to kind of create private options back in the 50s and 60s, 70s. But I truly believe that a Munger or a Buffett or Garrett or others like that during that time period would have really taken advantage of some of those anomalies, especially in the asymmetric style opportunities and situations.
Yeah, I couldn't agree with you more. It's one of those places that I still think you find really wildly mispriced things all the time, because I think that there are a lot of folks who use Black-Scholes or something to value them, and if you approach it like a value guy where you've got a view on one direction over another and something that's got no volatility because it's just been boring or it hasn't done anything for a long time, you get some wildly mispriced options in there.
Yeah, it's all about arbitrage. You're arbitraging kind of the models. And if you're going 2 years out and you have a fundamental view, I did that with Intra-West Resorts. That was the company that Fortress had in their private equity fund. It was partially public. And they did a tender offer at $7.50 a share. It ended up getting bought out at, I think it was $23.75 a share about a year later. And, when they bought 10% of the company back at $7.50, I bought stock, I bought options. I loaded up because the pricing was attractive on the options, but you knew that it wasn't going to be sold at $13 or $15. It was going to be sold at $18 or $20 or $24, and that's ultimately what happened. And so the Black-Scholes models don't take into account the idea that Fortress is the fund that they owned it in was in year 11, and they needed to sell this company at a premium because it was the last position they held in a fund that was a 2006 vintage. So they needed to do everything to juice the final returns of this holding, and that's not going to kind of go into these models.
So it's fascinating, Steve. If folks want to get in contact with you, what's the way to do that?
Yes, you go to the website, Arquitos.com, ARQUITOS. I'm on Twitter as well, Stephen _ Kiel. And, you can find me. I think I go to the website and send an email and things like that. I actually outsource my operations, Arquitos operations, to Willow Oak Asset Management. So you can always get in touch with some of our operational staff there. Jessica Greer is the primary contact for Arquitos. She works at Willow Oak. And then, come and see me at Berkshire Hathaway or the Daily Journal or some of those meetings.
Yeah, I'll be there this year. I'll make sure to say hello.
Absolutely.
Stephen Kiel, Arquitos and Enterprise Diversified, thank you very much.
Great being here with you, Toby.